Welcome everyone to our weekly live session as usual. The date is Saturday, April 23rd. And we just came off a pretty interesting week. A lot of bullish movement beginning of the week, and then we did get some you know um, downwards movement, mainly as a direct result of initially both the Netflix earnings as well as the day after, mainly the Jerome Powell Fed chair comments at the IMF Council meeting, where he sort of was questioned by a CNBC host and at the IMF meeting, and in that kind of public broadcasted interview, she was asking Powell some pretty difficult questions, and Powell sort of reiterated his bleak stance, but unlike before, where it was fairly somewhat balanced and a sort of laid out plan. In contrast, this time, Powell sort of was very bleak and kind of keen on mentioning that he would like to see equities lower. And in addition to that, that that his previous efforts sort of didn't really shift the move in the equity markets as much. And um, he mentioned as well that his priority is not the stock market; it is bonds and inflation, and that's what the Fed is prioritizing tackling. So it's pretty bleak statement. So understandably, we did sell off quite a bit, and I think in the short term, at least, short to medium term, based on Powell's mentions, he kind of reiterated a sort of almost guaranteed 50-point basis hike, which would come in May, which is next month, at the FOMC. And yeah, so I think that's kind of getting priced in. So I think now until then, doesn't really look too good, and I think we likely will head lower temporarily until then. And then by that time, I think the market will likely price in that 50-point basis hike, as we saw in the previous stance by the Fed. And I think that will sort of get priced in. And then other than that, in the short term, on my end at least, I'm looking to actually exit some shorter term long positions on a bounce, which I think we'll get next week, in my opinion. I don't think we'll head lower first. I think we'll sort of complete a bounce into Monday or Tuesday, and then begin to kind of have a continued sell off not long after that. And then also earnings will slightly dictate market movement somewhat, because we do have quite a few earnings from some of the large caps, mega caps, and the fangs. So some a few big ones. Coca-Cola starting off the earnings week on Monday pre-market, as well as Activision Blizzard. So two pretty big companies there, kind of staple companies there. So that's one to watch. Monday pre-market. Following that, Tuesday pre-market, we have UPS, PepsiCo, 3M, JetBlue, Waste Management. So quite a few there. On the same Tuesday after hours, we have Microsoft, Alphabet, Visa, GM, Enphase, Chipotle, Texas Instruments, QuantumScape, and Skechers. So, quite a few earnings there. Wednesday, Boeing, Spotify, T-Mobile, Harley Davidson. So quite a few there. And the same Wednesday after hours, we have a Meta, previously Facebook, uh, PayPal, Ford, Qualcomm, Pinterest, Teladoc, Hertz. Quite a few there. The day after, Twitter, Nokia, Mastercard, McDonald's, and then after hours, we have more of the large cap fangs: Amazon, Apple, Roku, Intel, Robinhood, and a few others. So quite a few. We also have ExxonMobil, Chevron, some of the oil reporting on Friday pre-market. So quite a few earnings, really, large earnings, especially, the FANGs, Apple, Amazon, Microsoft, Google, right? Big ones there, even PayPal, Facebook as well, Qualcomm, quite a few. So I think there'll be a lot of action in the markets and a lot of opportunities. So going to keep in heavy focus on earnings this week. I think there'll be quite a few plays. And I reiterate my stance that I mentioned last live session, which was last Saturday. I mentioned that I kind of saw this move in Netflix and Tesla coming into the week that we just passed, where if you listened last week, I mentioned that there's a really big focus this earnings, which is unique on really high expectations. I think just because of the fact that with Wall Street in and the world in such an inflationary environment, with higher rates and higher recessionary risks, I think that Wall Street is really looking for really solid numbers, right? And if you're not, meeting those solid numbers, even if you're exceeding expectations, if there's some sort of, negative outlook somewhere in the earnings, including even in the guidance, your stock will be sold off, right? Because we are at quite high multiples, even for some of the companies that got sold off a bit. And if you're not exhibiting those numbers, you don't have heavy cash balances like Google, Tesla, Apple. You don't have low debt like Google, Tesla, Apple. You run the risk of downside in those environments. And then also, when you don't have any debt like Google, Apple, Tesla, you're not really affected by inflation as much and rate hikes, because I mean, you're not borrowing any debt, right? So those rate hikes don't really affect you, so to say. In the inflation end it will, but you can all it's really an offsetting pattern where companies raise the prices of products and goods to combat inflation, sort of pushing inflation higher, but protecting the company, sort of, which is kind of a never-ending cycle, which is how inflation works. But yep, when you don't have that debt, you're really protected, and as I mentioned, like maybe last month, those are the companies to put money in these high rate environments and recessionary risk environments, are companies with no debt and just heavy cash, because those are really where the companies that are going to shine. And then if you look at Apple as well, or sorry, Google as well, which is really unique, is that Google is one of these only companies that are just growing so fast and printing so much money that as the share price increases, we see the PE actually contract, right? Because it's they're just printing so much money, and outpacing the rate that they're actually growing as well, right? So yeah, I think these are good opportunities, and I reiterate those thoughts going into this earnings, because this earnings week, because I think we'll see the same type of action that we saw at Netflix. Likely not as much, but my point there in saying that is that if let's say, I'll pull a company like PepsiCo, for example, just an example. If they're not producing those really solid numbers, their stock is going to get sold. That might be one that's a little better price, but let's say something like, maybe Chipotle, something that a little bit on the higher spectrum, price to earnings wise, and if they're not producing those really solid numbers, analysts will kind of look to sell the stock from there. So I think we'll see those kind of similar movements. Again, there's only a handful of companies that I think are really have the ability to produce those solid numbers. But not to say other companies might not go green. I just think that it runs the risk more so of downside than upside for majority of these companies that don't exhibit those really clean balance sheets like Google, Tesla, Apple, even Amazon as well. Um, so yeah, another one is like Facebook, for example. I think Facebook. I don't think their earnings will do too good. They kind of started declining last earnings, and then that's when they sold off. Um, their market cap has come down quite a bit, so I'll look at the stats there, but um, yeah, Facebook might be one. And then last thing before I pass it to DJ is another big one this week to really focus on is Twitter, which will be interesting because Twitter right now is really solely being held up just by the Elon news, and um it hasn't sold off at all, right? And even on Friday when the whole market was red, Twitter was pretty much the only stock that was on the equity side that was green, right? And basically being held up by just this Elon buyout news. Elon's pretty much I think he's basically secured it. He's going to pretty much do anything to get that buyout. He's looking to bring in partners, as I mentioned before. So he'll get it done. We're still slightly below the buyout price, but yeah, assuming efficient market hypothesis will kind of get to that um, buyout price. But what's really interesting is that they do have earnings on Thursday, and I suspect that Twitter earnings will be quite bad. And especially for where the stock is right now, right? It'll be really terrible earnings. Um, and it'll be interesting to see though whether it actually sells off on an earnings report. And if it does, I think it's a good buy. Um, but I really don't know if it will because it's really weathered the storm quite well just solely because of this Elon news. I mean, it's important to kind of realize that I think if this Elon news wasn't really active in the media, I think we'd be at the low 30s, in my opinion even 20s, because a lot of it's supported by Elon bulk buying as well throughout January. So we see Twitter in the 20s right now, which is almost half of what the share price is now. So it's quite significant there. So it'll be interesting to see if we really do sell off on earnings. And I think if we do, that's a great buy. And I think it's more likely that we will um, because for one is that um, there's not really any reason to buy Twitter on any earnings, right? So that's one, and then two is that Twitter will have a conference call preceding the earnings report release, and in that conference call, I mean, it's just executives and maybe one or two board members, but really all they're going to say is the institution will ask questions about um almost solely about the Twitter buyout, and nobody will ask anything about the earnings. Nobody cares about the earnings, and the entire portion of the entire conference call will be all about Elon buying Twitter. And obviously this is a one-sided conversation where Elon's not in, so you're going to get management kind of completely forwarding the question in a way where they're saying that they're doing everything they can to make sure Elon doesn't buy Twitter, and for one, adopt the poison pill and possibly go even further than that, right? And whatever needs to be done. And I think that is likely to put downwards pressure on the stock because people will price based on the Twitter management's board. Parag will definitely be on it, the CEO, 100%. And based on what they say, that they'll probably try to kind of paint the narrative that Twitter is going to make sure that Elon doesn't you know complete this buyout. And once that happens, I think it's quite likely that we see a sell off in Twitter. And then on top of that, it's even exacerbated by negative earnings, especially where this compared to where the stock price is right now, right? which is quite high for Twitter's performance. So yeah, that's one to really watch, which is on Thursday. So I'll be looking out for that. I think even an options play to the downside on Twitter, it's pretty good. But more so, I'd be looking to actually buy Twitter shares on that dip, after hours. Depending on where it goes, if it's a 2% dip, not really significant. But I'm talking if we sell off quite significantly, it provides quite a discount that I think is highly profitable. Um, so yeah, that's good. And then you could even do a spread trade there, so you can kind of get the shares in hand and sell some options to the downside, or even go long on puts depending on the price. So I'll monitor that this week and keep you guys updated. But quite a few plays that I think will be possible, and quite a few movements in the market we'll see this week. There are no Fed speakers this week, so markets likely to be dictated based on the after effects of Powell's comments, and um, but more so majority on these earnings reports, especially the mega cap earnings like the Fangs, remaining Fangs that are reporting this week. So yeah, quite the action that will come this week. Pretty exciting. So yeah, we'll keep you guys updated. I'm gonna be kind of analyzing earnings throughout the week, getting the best opportunities, and kind of trying to play it in a pretty safe manner. Market's still pretty volatile currently, so get the best plays and go on those. So yeah, that's it on my end for now. Just going to pass it to DJ to share his thoughts and go over his usual SPY analysis.
Yeah, sounds good. So, so I pretty much echo the sentiments that Ramji just mentioned. I think this earnings season is pretty much skewed towards the downside. So I think for companies that actually put up really solid numbers, I really think the most they're really getting is maybe 10, 15% at most upside. But it feels like if companies just uh, miss their numbers, which is very likely based on challenges of the last quarter or so. I think they'll get punished like 20, 25, even 30%, something like Netflix. Um, I think most won't do as bad as Netflix, but I think the downside is probably twice as big as the upside in this upcoming earnings season, in my opinion. I think a lot of analysts are looking for kind of reasons just to kind of downgrade a bunch of stocks and holdings. The market isn't looking too hot, so I mean, it's really hard to imagine many companies that can actually give better forward guidance from these levels. Like there are companies that could definitely beat their numbers, beat the quarter, but if you're talking about future guidance, I mean, I can't really imagine the future guidance being good for kind of like any company right now, just with all the kind of supply chain issues and inflation and stuff. I don't think, I really don't think that companies can provide good forward guidance going forward. So I really do think it's definitely skewed towards the downside on this earnings. So um, based on the IV, puts could pay more likely. There's a couple of plays that might do well on the upside. Um, I think something like Facebook Meta is very interesting. Um, that's a company that right now I believe is trading at a P of 13, which is like historical lows. For context, I believe right now, like after Netflix dropped another 40% on their latest earnings, and it's down to like the 200 level on Netflix. I believe they're still trading at a P ratio of 20, whereas Meta's already trading a P ratio of 13, when I think it averages something like 20. 225. So if it were to, you know, provide poor guidance and miss the quarter again, I somehow drop another 30%. I mean, it might be trading as low as something like a P of like 7 or 8, which would be kind of insane. But at the same time, it's clear that the users are kind of declining on the platform. It's just kind of like you believe in their metaverse plan, whether or not it will kind of provide value in the future or not. But other than that, you have pretty good cash flows and everything. So um, I think like Netflix is something that's difficult to kind of buy the dip on, in my opinion. But Meta, I think, has a stronger case than Netflix if I were to pick one or the other. But to be honest, overall, looking at the market, chart-wise, I mean, fundamentally wise, nothing too much changed. Inflation still persistent, war is still ongoing, supply chain issues are still ongoing. Um, Chart-wise, we're recently where we a few weeks ago kind of retook the uptrend and rallied very hard, like 50 points on the S&P, 50 points on QQQ. But now, really, this pullback, in my opinion, is this is not the sort of pullback you would get in a melt-up scenario, in my opinion. What I mean by that is, I think the retracement of this move is is too much to continue a sustained run up. So what I mean by that is we pretty much rallied from 420 on SPY and went up more than 40 points to the 460 level. If this was to kind of continue like a healthy uptrend, you would retrace something like 50% of that move, which would put you around, the 438 to 440 levels, which we were just a few days ago. And that would be a good higher low to kind of base and continue to move up from there. But now that we had that bounce back to 450, in the span of 2 days, like literally the span of two trading days, we dropped 25 points on the S&P, which is like more than a 5% move. I think almost a 5 or 6% drop in the span of 2 days. Um, Not only is that concerning, but what's more concerning is that you pretty much retraced from 420 to 462 back to 426. I mean, this is essentially like a 80, 85, or 90% retracement of the initial bull move. And to retrace that much of a move means that it's unlikely to continue a sustained uptrend. So the expectation from here, in my opinion, is I do agree with Ramji. I think earlier next week, I think we are quite oversold right now with the magnitude of the drop recently, based on Powell's comments. So I do think we will get an early bounce into the week, maybe something back to the 430 range, 435 range. But because we traced so heavily from the initial rally, it's kind of hard for me to imagine that we can give back pretty much almost the entire move up and then melt up from here. So what I do think is the more likely scenario is we would just see a bounce and then a retest of lows. And I think this market is going to stay very choppy and very range bound for a while. I think we might see the S&P between this 420 level and 460 level for potentially another month or more. It's a very big range, and unless something significant happens and breaks one direction, um, it's hard to really see it kind of take off. I would say at this point it's actually even more likely to break down than up, considering we're only around 5-10 points away from that 420 level on the S&P. So it's more likely to break down than up, especially with all the upcoming earnings, huge earnings from FANG and a whole bunch of, large cap tech, medium cap tech. And like I've mentioned, it's just the earnings season is definitely just skewed towards the downside. Um, we've seen it. We've seen it a bit last season where we've seen stocks get punished 25, 30%, and then we've seen stocks that actually did really well on earnings. Like, let me just pull up an example. Something like an Upstart, where we saw, they were trading at the low hundreds. They did really well on earnings, gapped up and ran to even 150, 160. That's almost a 50% move. But I mean, if you look at it now, it's trading at 75, which gave back pretty much another 50, 60% from that earnings beat, and now we're trading like 25% lower than the level pre-earnings. So it really felt like anything that beat earnings got a gap up, but it pretty much got sold off. And anything that kind of missed earnings just got directly sold off. So it isn't really looking good this earnings season, in my opinion. There are definitely companies that I think can do well. I think Google, as always kind of does well on earnings. So we could see a move on it. The one thing I am a little bit of a concern on Google is that um, they had an incredible quarter last quarter. And they did gap to pretty much near all-time highs, I believe, around 3,000. But that they also combined that quarter with the stock split announcement, which I believe gave them about a 10% gap up, give or take, something like that. So I'm not sure how much of the quarter was that 10% move as opposed to the announcement of the stock split. Um, at this time around, there is kind of no stock split. So I mean, like say last quarter, Google went up 10%. Say maybe the good quarter attributed to like 2% of that move, and maybe the stock split announcement contributed to 8%. So that pretty much meant that even a really good quarter didn't really, provide any of the move. Uh, you know, so this time around, as always, I mean, kind of people expect Google to do well on earnings as they've done for like the last 2 years. But this time there's kind of no stock split. Same as Amazon, there's no stock split announcement going on. It's all kind of announced. So I'm really not too sure. And then um, take Tesla. They reported really good numbers, which is why we saw a 10% move on Tesla. Um, we saw a 10% move on Tesla when they reported earnings last week, and it was a really good earnings report, and we saw a 10% move up. But really, in the span of 2 days, it pretty much gave back the entire 10% move, and now we're back to pretty much pre-earning levels because the market kind of fell along with it. So like to me, it doesn't really seem like the individual stocks performing well in the quarter is really doing too much. I think it's kind of just like a repeat of something like Upstart, where if you have a good quarter, you'll gap up and make a move. But it feels like in the, when you're looking forward in the next few days or next few weeks, ultimately it just kind of goes along with the market. If the market goes down, then you just fade the entire move and perhaps go even lower. So it's not looking too good. I think honestly, the premiums also are getting quite expensive because of what happened to Netflix. Now, people are starting to price in 20% moves, so it's a little bit hard to look for premiums in either direction. Um, I think, it's important to kind of watch earnings to see, to get a bit more of market clarity to see what will happen. But definitely, I mean, it's hard to imagine any good numbers and any good forward guidance coming out. I mean, this is the quarter that pretty much right? The majority of the companies got hit by Russia, Ukraine the most, and they need to update their forecast for that catalyst that occurred. Is pretty much negative all across the board. So I mean, I can't really see straightforward guidance coming, and you know, I thought you could maybe make the argument that the week forward guidance is perhaps already priced in, but from some of the earnings that we've seen so far, it doesn't really look like it's getting priced in too much. So I think perhaps there is a kind of just a lot more room to go down. But we'll go over the charts. So SPY daily chart. We're back under the daily EMA, back under the daily middle Bollinger Band, and right now we're even trading lower than the daily lower Bollinger Band. We're kind of just in free fall mode. So I suspect we will bounce on Monday. We might move 430s. I think it'll be unlikely that we'll tank like I don't know, like 40 points in a span of 3 days. I'm pretty sure the hourly. Yeah, look at this hourly chart on the S&P. Like what is this? It's like 20 like I don't even know, 20 hours in a row of red or something like that. The RSI from like 66 to 20 on the hourly. 20 RSI on the hourly on the S&P is something like very rare. It has not happened many times. It usually happens we dip around 22, 22, 22, and we get all major kind of bounces near the low 20 RSI levels, and we're pretty much at 20. So I mean, this definitely favors a short-term bounce coming next week. I think Friday was a lot of panic selling just because the whole week was weak and people just wanted out. So definitely, I think Monday should be green and a solid kind of bounce move. But once the RSI kind of cools back to the 40s, etc., then it can prepare for another move down, essentially. SPY weekly chart, we are still in a range. So, we have this kind of double bottom at 416 and then our high on 462, and we're looking at a weekly higher low. Technically speaking, it could just be anything above 416. You could call it a weekly higher low, but to retrace again, like 90% of the move is too much to be bullish in my opinion. So, I do expect to hold 416, 420, and I think we will get some sort of bounce back to maybe the 435, 40 levels, and it will kind of just chop. And I'm thinking it might just take until May or even late May to figure out whether or not we can break out of this 460 range or fall below this 416 range on a weekly. But I will say it's not a good look since large upper wick, falling. Weekly EMA still downward sloping, and we've seen the daily EMAs on SPY that were upward sloping, you know, turn back downward. So unless we can turn it around pretty quick, um, these indicators are going to be continually to slope downwards and make it troublesome for the market overall to kind of sustain any levels of up. QQQ, honestly, even weaker than SPY. Not not to any surprise because tech, right, is kind of the thing that gets hit the most during these periods of high inflation, etc. Yeah, we're really close to breaking the lows that we held on QQQ. Just about 2% away from dropping to 318 levels. And it's really not looking too good here on QQQ either. Weekly, kind of similar, but we're closer to support than SPY is. There's a lot of support levels on this way down, so if we do keep falling, it's definitely worth some sort of short-term bounce play in my opinion. But other than that, it's hard to see a great trade. Personally, on my end, on this market, I'm pretty much like almost all cash now. I don't really want to buy in the melt up thesis. I don't really want to buy in the crash thesis yet. I think either is still on the table and possible. But at the same time, I think it's the market is too choppy right now, and if you're wrong on either direction, the options will punish you pretty hard. And I mean, forget even the options. I think even shares will punish you pretty hard if you're, on the wrong side of things because it's very volatile right now. So I would prefer to kind of take it day to day. If we're oversold, play some oversold bounces. If there's some good premiums on earnings, play some of that. Sell some premiums. If there's a really good kind of play to kind of buy, then add some shares, etc. But for the most part, I'm mostly on the sidelines, kind of waiting to see what the market kind of wants to do from here and develop. Um, IWM daily chart. I mean, it's pretty much the same thing as buying QQQ, just extremely weak and fading uh, pretty much all of the gains, right? So it's not looking very good on small caps either. So uh, overall, I think the market is looking weak, is looking bearish in my opinion. Um, Short-term oversold, so likely to get a bounce. But once we get that bounce, uh, if we don't push it up like 30, 40 point rally again, I think we will be looking to retest the the lows in February and March for the market overall, and then we'll kind of take it a step um, at a time from there. Um, the last thing I'm going to mention is I believe May 3rd is the next Fed meeting. 0.50 basis point is priced in, I believe. Um, what happened last time was we had a massive sell-off heading into FOMC, and then we reversed, I think, just a couple days before FOMC, and then we went on this crazy 8-day rally when they hiked a quarter point. Um, so I mean, this time around, maybe we might see something similar where, we're getting this ugly sell-off heading into the May meeting, and we could see it reverse from there. But um, I don't know. I think it'll be a little bit more tricky than just that. I think earnings season will, you know, make for a lot of surprises, I'd say. Something like Apple hasn't ever really done too poorly on earnings, and they've never really dropped too much either. But I mean, like if something like Apple tanks like 10, 15%, and I mean, this entire market is definitely going to lower lows. So I mean, a lot of key earnings are coming up, so I think it's definitely a focus and kind of just take it a day at a time. So yeah, that's it from me this week. So I'll pass it over to Ramji for him to share any closing thoughts.
Yeah, sure. So yeah, I kind of shared my thoughts. So I don't need to share my screen. You could just keep it up. But just to reiterate, and then one question. P Meadows just asked, are you holding Netflix shares as a long-term hold? Yeah, I actually am. Currently, I'm gonna see where it goes. My average is about 218, which is pretty not bad, pretty good. And the reason being is that I think despite the user growth kind of pause or drop or decline, you could say in user growth. I think that advertising is a really solid model. The subscription model is great when you're growing users, right? And once you get to, you could classify Netflix as sort of leaning from growth to value, which is why we saw really significant drop, right? Upwards of 40%. I think even lower than that now for from the pre-earnings drop. Um, so pretty much cut in half. Um, and I think it's because I think you really need to see a decline or a flat line in users over maybe three consecutive earnings. I kind of classify it as moving from growth to value, and then the stock price will adjust to reflect that. But I do think that I think that Wall Street is sort of underestimating the ad model in Netflix, and I think advertising is big business. Advertising is the model that pretty much every social media company and every sort of social tech company utilizes, and I think it's a good model. And since their sort of user base or user growth is slowing, I think it's a good move to shift into it. I did listen to the conference call, and management seems sort of not necessarily has any like solid plans at the current time, but I do think that the drop is a little bit overstated for the fact that they are moving into an advertising model. I think this sort of move that they're doing from management of trying to crack down on subscription sharing and whatnot isn't the right move. I think that's pretty obvious, and I think that's not the right move to go. It's sort of desperate to keep users, but I do think that Wall Street and analysts are underestimating the ad model and sort of assigning a little bit too much of a discount there. And I think it can be quite big business. So I think heading into their next earnings, if they were to implement advertising soon, I think that it will prove to be really effective, and I think it can be a quite successful strategy to generate marginal return from that advertising model. And then on top of that, you have the existing user base continuing with subscriptions, and subscription price has raised, and people don't mind it. They're sort of price insensitive, so it's not a really a price sensitive business. So you can sort of raise the prices, which they've done multiple times, and they don't really lose users from that. I think the user growth is just the main thing. They have lost that 200,000 users net um, this time, but again, I think the advertising model is quite lucrative, and I think that it's not being it's a little bit over exacerbated, the drop. So I think for a short term or even a long term into at least next earnings is a pretty good play. So I picked up shares there, just a small position, but I think it's a pretty good risk reward. So that's the sort of thesis on Netflix, because I really do actually like their advertising model that they're shifting into. So I think it's just solid. I mean, you get tons of money that way, and broadcast the advertisements. Respective of consumer demographics and this consumer profile. Pretty much exactly how YouTube does it, but a little bit more broad because Netflix doesn't collect that much data compared to a company like YouTube, which is very data focused. So they have a complete consumer profile for each and every YouTube user, whereas Netflix is a little bit more lenient and more liberal in that aspect. So yeah, but I think that advertising is solid business there. So that's my thoughts on Netflix. And then other than that, yeah, as I mentioned in the beginning, that the focus is on earnings this week, and it'll really dictate the market quite a bit. I shared the same thoughts as DJ on the indices, um, and yeah, I think there's quite a few earnings, really big ones that are really interesting as well. Again, like Twitter, I mentioned my thoughts on that. I think that there's a lot of opportunity there, and it'll be interesting to see how we react. And again, I think that the likelihood is much more to the downside because of what management will say on the conference call, as well as the fact that earnings will be quite bad for Twitter, especially where the stock price is. So good plays there, and then all the fangs as well. I think again, there's just companies that will produce really solid earnings, like Google, coming into this, and then there'll be companies that I think will get pretty sold off, based on not having a really clean balance sheet and ability to produce really solid numbers uh, that analysts are looking for in this higher rate environment and recessionary risk environment as well. So quite a few opportunities this week. I think it'll be an exciting week. Quite the movement, and it'll be market movement will be pretty much entirely dictated on earnings, especially these mega caps and fangs. Especially through about half midway to the latter half of the week, almost entirely. I think on Monday I'm expecting a bounce because we're quite oversold, as I mentioned on Friday. But I do think we will go lower likely following that. And that's the most likely big, just based off Fed Chair Powell's comments, which are really really bleak, pretty much the bleakest it's ever been. But then I think we'll get some quite solid possible upside moves on these Apple, Microsoft, Google, Facebook, or Meta type earnings. Amazon, Roku. These are the kind of mega caps where um they'll really dictate market movement, at least in the short term. So for a day or two, you could see a solid bounce on, let's say, solid Apple earnings, for example. So yeah, really a lot of opportunities this week. It's a big earnings week, and a very unique one, as I mentioned, last week as well, because analysts are really looking for those specific numbers and specific performance in this coming into this earnings season. So um, yeah, we'll keep you guys updated. But other than that, I hope everyone has an amazing remainder of the weekend. I'll upload the full live session for anyone who missed it. And I hope everyone has a great remainder of the weekend. And we'll be back on Monday to go get this money, guys. So take care, everyone, and enjoy the rest of your day.
Yeah. Cheers, everyone. Take care.